I just met with somebody today that said, your 401k, you've mortgaged your 401k. Like, no, I haven't. There's no lien on it. The IRS is your partner. They own a portion of that, and you just don't know how much is theirs yet until you have to pay the taxes. And so knowing what you have to spend in retirement's key.
Hi, and welcome to Beyond the Paycheck. I'm Paula Christine. So lately we've been talking a lot about mindset, and last week we talked a little bit about money and investing. So this week we are going to talk about all things retirement. So I'd like to welcome Mel Stubbs. He actually wrote a book called Your FERS Federal Retirement. And so we're going to talk a little bit about that and then some steps for, I actually like the topic of taxes, because I don't think a lot of people really understand the tax situation when they go into retirement. So let me just say, welcome, Mel. How are you?
Glad to be here.
Okay. So I'm going to let you lead the conversation. So tell me about taxes and retirement.
Yeah. So the book is Your FERS, and the FERS stands for Federal Employee Retirement System. So if you're a Fed out there, the book's for you. But most people we help are federal retirees where they have a pension. They'll have Social Security. The spouse will have Social Security. So they've got some guaranteed income coming in. And so in their world, it's called a TSP, a thrift savings plan. But in other people's world, it might be a 401k or 403b or those type things. But most of the people are saving money traditional. They're getting the tax write-off now. They're going to pay taxes later. And who cares about later because it's later? Well, sometimes later ain't later anymore. And there's such things called required minimum distributions. Right. So if you're not touching your money all the way 72, 73, or 75, depending on how old you are, you got to start touching it, and it's taxable. And so for the people we're working with where they've got a pension and Social Security, their income is pretty decent already. And when they have to start touching it, and they're mandated to, they can lose control of their taxation, and their income can just kind of skyrocket and, jump a tax bracket, sometimes jump two tax brackets, and they didn't think about it. And so we're trying to help warn people before that. Let's do some of the planning before that happens.
Yeah. Well, we were told max out your employer retirement plan as much as possible. And, because you're going to be in a lower tax bracket in retirement, but you're not. People are not. If you plan properly, you're not in a lower tax bracket. Because I always say, what are you going to give up of your things that you're doing today to make sure that you're using less income? And nobody wants to give anything up. So ideally, you want the similar amount of income that you have currently when you go into retirement. And then you have to withdraw all of that money out, and it's most of the time 100% taxable.
Yeah. I mean, if all of your sources of income are taxable, if it's a pension or Social Security, or I'm going to take a distribution, but if you want to maintain the same lifestyle and every source is taxable, you're going to have similar income. And so I'm going to drop tax brackets probably is not true for at least a lot of people.
Right. So, and I'm not sure when the Roth came into picture, but most people didn't contribute to the Roth IRA, and now they've got the Roth 401k. So if you are in your 401k and you can use the Roth version, it may be better, even if you split it between the traditional and the Roth, might be a better option than just doing 100% traditional.
Yeah. I mean, the math is all about the tax rate that you pay. What tax rate are you paying today versus what rate will you pay later? And I mean, we can say things like, pay taxes on the seed instead of the harvest. But the way the math works, if you pay 22% today or 22% 20 years from now on a much larger balance, the math is exactly the same, just the way the math works. It's all about, if I'm 22 today, but I'm 25 later, Roth would have been better.
Right.
And so it's what is the rate? It might even be hey, I'm in the third tax bracket up. Awesome. You might be in the third tax bracket up 20 years from now, but what number is going to be on that bracket? If that number is higher, it makes a difference. And for most people, they're 95 to 100% all traditional. I mean, there's no diversification. Everything, I'm going to pay taxes later on everything. And if taxes move the wrong direction for you, it can be very penalizing.
Well, and then you got to consider if you're married and your spouse passes away and you've still got that similar income and coming in and then taking withdrawals from the account. And it changes a lot of things that can put you in a higher tax bracket.
Yeah. I mean, our verbiage for it is kind of the widow or widower tax trap of, pensions go down a little bit depending on what, since we're working with federal employees, we kind of like if the wrong person dies early kind of thing. But if the Fed dies early, their pension changes. Whoever dies early, the smaller Social Security goes away and you get to keep the bigger Social Security.
Correct.
But like the required minimum distributions that are forced to come out, if one person dies, the remaining person still has to take them.
Right.
Like that doesn't go down. But the tax brackets, most of them are cut in half. Not all of them, but most of them, to where there's just less room. And so you move up the tax brackets faster.
Mm-hmm.
And so my income went down a little bit when somebody died, but the tax bracket went down a lot. And you could end up paying higher taxes than you thought.
Right. And then you've got the more you're taking out to taxable income, more of your Social Security is taxable because up to 85% of it is taxable. So that plays a factor in it too.
Absolutely. And then where we run in with people, Medicare premiums. Medicare premiums are based on your income.
Yep.
And so if your income suddenly, we got people for every $1 million, you got to take out around $40,000 of a required minimum distribution. And so, somebody's got $1 million at age 60, they might have $2 or $3 million at age 75. They got to start taking money out. Suddenly, not only am I getting taxed on all this money I'm taking out that I don't really need, but now my Medicare premium is jacked up for me and my spouse. And
then you have advisors that don't know the rule and, talk to people about doing Roth conversions. And then all of a sudden my Medicare premium's up.
A lot of times when we're doing Roth conversions, we're looking at your tax bracket, your taxable income, trying to get that number correct. But the way they figure Medicare premiums is not on taxable income, but on adjusted gross income, where you have to add back your standard deduction and add back several things. And so you can hit that, you can think you planned well and still go over the limit for Medicare. And there's a 2-year look back. So at age 65, when you turn it on, they're looking back at your tax return on age 63 of what your income was. And so if you're doing Roth conversions and large ones, 62 and earlier is when you kind of need to do it, because once you hit 63, you now are messing with Medicare premiums.
So let's talk about, you can take your required minimum distribution and give it to a qualified charity.
Yes.
If you feel generous, and not pay taxes on that contribution.
Yep. So it starts at 70 and a half, actually. So back in the day, your RMD started at 70 and a half, but they've shifted those dates later, 72, 73, or 75. But they still left the rule at 70 and a half. You can start giving money directly to a charity, like a 501c3, directly from your IRA, and it is not a taxable event. So you can give away your RMD up to $100,000. I think most people that probably fits in. They're okay with that. They don't need to give more than that. But yes, you can. And that's one thing, as we're helping people realize that maybe I don't want all this traditional money. We'll actually illustrate for them, what if we just Roth convert everything? Now, it might take years to do, but we illustrate Roth converting everything so you can see I got 100% traditional, I got 100% Roth. Wow, look at the difference. But in reality, if you are charitably minded and you are giving money away, it probably makes sense to leave some traditional. And whatever, hey, I give to my church, every month I write a check to my church. Awesome. At 70 and a half, how about quit doing that? And we'll give to your church directly from the IRA, save you some taxes. Some of that type planning can be helpful.
I'm going to switch subjects on you. I mean, it's the same subject, but the inherited IRA rules changing to the 10-year withdrawal. Yes. So that's affecting a lot of people that have those $1 million, $2 million 401ks, and they have one child and they pass away, or not the child passes away, but the parent passes away, and that child inherits that 1 million, has to take it out over 10 years. And then it's affecting their tax bracket. Absolutely.
Now, I think studies show that studies show people blow the money in 2 or 3 years. So the whole 10-year rule, most people, it's fine. They're blowing the inheritance way faster than that. But let's talk about the people that don't do that. They're planning. They're going to, back in.
Yeah, but still, even if you blow it in 3 years and having to take out $1 million,
yeah.
I mean, just do simple math, say $300,000 a year. And if you're making $200,000 a year, now your income's up to $500,000.
Yeah. So as we're doing some tax planning for people, we're looking at their tax, what tax rate or bracket are you in? What tax bracket might you be in? And then what tax bracket might your heirs be in? And some people are really worried about that. Yes, let me Roth convert so that my children don't have to. Other people are like, you know what? Phooey on them. They get what they get, and they can pay their own daggone taxes. So whichever. But I mean, yeah, I'm sure there are cases where children are inheriting money in their high income years. And now that they can't stretch it forever like they used to, now they have a 10-year window. And if it's all traditional, can they wait till like year 10 and take a huge amount out? I mean, I guess, but they'll be taxed hugely. So, it probably makes sense to even it out, to spread it out, to not pay as much, but still can be a lot. And Roth would fix that. If you had Roth and you leave it to a child, they still have a 10-year window, but it's tax-free. So they could let it stay in its Rothiness for 10 years, and you got to take it out in year 10. But Roth helps you while you're living, and it can help them, or whoever them is, up to 10 years afterwards.
So there are other things that you can do too. I mean, if you're healthy and depending on your age, you could always purchase a life insurance policy because death benefits are received tax-free, and that could offset the taxes. Use some of your RMD to buy the life insurance, then offset the taxes.
Yes.
The death benefit will offset the taxes for the children.
And a lot of the policies we are using, a permanent life insurance, I guess the old-fashioned word was whole life, but it's now indexed universal life. But no matter when you die, it's going to pay. But a lot of those have riders built in. It's called a chronic illness rider. We call it like long-term care provisions, where the death benefit's a tax-free death benefit if you die, but it's also a bucket of money you can spend for long-term care if you need it. And so it can kind of kill two birds with one stone there.
Right.
And yes, you can fund it with portions of your RMD that you don't like. I don't really need this money. What do I do with it? This is a way you can kind of multiply it. I've heard it said that like life insurance, you can buy dollars with pennies. Okay, maybe. I mean, but if you're in your 60s or 70s, okay, maybe you're buying dollars with dimes or you're buying dollars with quarters. It still mathematically can work out.
Probably more like a quarter.
A dollar with quarters, but
no,
it still can be worth it.
Yeah, it says, it's still expensive based on your age. And of course, hopefully you're pretty healthy. I mean, if you're not, then it's going to be a little bit more expensive, but there are other types of accounts. So like if you were talking to younger people, they could use a pre-tax situation for part of their money. They could use Roth for another portion. And then they can also look at it like a non-qualified account where the taxes potentially are on capital gains, which depending on your tax bracket could be nothing.
Yes. So, I mean, those are kind of the three buckets. You got the tax-deferred, traditional, tax-free Roth. I guess do keep in mind you're supposed to be 59 and a half and or over to touch your gains and have had a Roth account for 5 years. So those little sticky points can come back to bite you if you're not worth paying attention. And then the non-qualified, that means it doesn't qualify for any other tax advantages. We kind of call it a taxable account, where like if it's a CD or something like that at the bank, you get a 1099 every year. Like my dad's having to do quarterly withholdings for the first time ever because he now's got some CD money that he's got to pay taxes on. If you get a brokerage account, you get to control the taxes a little bit because you're only paying if you have a transaction. Like if you sell something and have a profit, well, now you got to pay and you decide that. But I mean, as we're talking right now, the stock market's not doing so hot. So lots of people could have all these gains. The stock market goes down some and they say, oh, get me out. Not realizing that, okay, we'll get you out, but you still got a lot of gain. So now you just lost money. You're not happy. A tax bill is coming. You're not going to be happy. And that's where if you can do some shifting and maybe get the traditional to Roth, but like how can we get the non-qualified to Roth? I mean, how do we get more of the money to Roth so you don't have to worry about so much taxes? That can be beneficial.
Yeah, just even having, well, the nice thing about the non-qualified bucket too is that you don't have to be 59 and a half to access it.
Yes. Everybody needs some money in every bucket. I mean, it's probably why you need some. We'll just be talking to people and like, oh, how much money you got at the bank? Oh, I got 400,000 sitting at the bank. That might be a little much, maybe like the problem is too much.
Today that might be good.
Depending on the day. And that's, like, I got $1 million in my 401k. That's traditional. Like, I mean, great, better than zero. But, I just met with somebody today that said, your 401k, you've mortgaged your 401k. Like, no, I haven't. There's no lien on it. The IRS is your partner. They own a portion of that, and you just don't know how much is theirs yet until you have to pay the taxes. And so, knowing what you have to spend in retirement's key. Yeah,
that's a great analogy. I like that.
See, we have a little. I don't know if you're listening, you can't see this, but it's a wad of money. As you get nervous, you can squeeze it. But it says no longer theirs, and like theirs is spelled the IRS. So we don't want the IRS. We need it to be no longer theirs. It needs to be yours. And you don't really know how much is yours. If you see your balance, I got $1 million in my 401k. Like you don't have $1 million in your 401k. I hate to be the bearer of bad news, but a portion of that to the IRS you've probably forgotten. And when you take some money out and you got to pay them, you feel like I am losing a certain amount of money. I mean, I didn't lose it. It was always there. You just forgot about it.
So Mel, you've shared with us a lot of great ideas about, it's really about planning for your retirement well before you get there, and sitting with an advisor and looking at what buckets of money you do have. Do you have all pre-tax? Do you have after tax? Do you have that non-qualified bucket that we talked about? And developing a strategy to build those, maybe do some Roth conversions if needed. And then when you get to retirement, you're not having this conversation with an advisor that all my money is taxable. You'll have multiple different buckets of money to pull from. So I got that right?
Absolutely. The sooner the better, because when we do little like seminars and stuff, the young people don't show up. It's fine. They don't show up. But most of the stuff we can help people with are at retirement age, because you can't really get to your 401k or your TSP until certain ages. I would also...
Yeah, but you can diversify. You don't have to put everything into those. You could put some of your money in there, and you can put some money in a non-qualified account. You don't have to max out your retirement account every single year. You need to look at other options.
Sure.
Yeah.
And
the problem with the kids too today is that they don't come to seminars. One, they're not geared towards them, they think. But as a parent, could you not educate your child, or even just bring them to your office?
Yeah.
And set them down and let you explain it to them.
Please pass on wisdom before you pass on money. For sure.
I like that. You're really good at that stuff.
Come on. It's not our first rodeo. Yes. So, we got lots of clients. We help a decent amount of clients' children. I mean, we'll meet with the children. Not every child is right for us to work with, but I mean, yes, if like there's going to be a family meeting, when you pass away and money's going to kids, like there's going to be a family meeting. Let's have one while you're still living, so you can pass on some of what you want. And if we need to be there to help kind of direct it or whatever, we certainly can do that. And just as far as...
Well, education is key for everybody.
Yeah.
I mean, it's really important. And, I talk with women all the time, and I'm like, just read books, ask questions, talk with your girlfriends, listen to podcasts. There's a ton of information out there.
Absolutely. And I would say, some people want to do this themselves, do it yourself, or do it. There's lots of information for you to get. Others want to either collaborate with somebody or just delegate. And I just want to work with somebody that knows their stuff and then let them do it. And that's where I guess our focus has been on federal employees, helping them with their system. Is kind of complicated. Whoever you're working with, make sure they're they specialize in whatever you've got going on. Whether you're a dentist selling their practice, somebody specializes in that. So just a generic person that kind of helps everybody. I would rather find what is super unique about your financial situation and work with somebody that's all they work with. So, I mean, if you're a federal employee, we're your people.
You're the guy?
Yes. The book we wrote is all about your federal retirement and the 10 decisions that you got to make at that federal retirement. It probably means that all the people that aren't federal are probably not dying to work with us. That's okay. There's enough federal people out there that, we'll specialize in what we know best.
Are you licensed in every state?
Yes. Now, California and New York don't really play well with others. So certain things, life insurance we can't, and annuities we cannot do in those two states. But as far as helping them, manage money, plan, all that stuff, yes, all 50 states works well. And if I can do a shameless plug of the book, it's christycapital.com/decisions. Get you to the book on federal retirement if that happens to be you.
So, Mel, I really appreciate your knowledge, and thank you for sharing your expertise with us. If anybody would like to reach out to you, how do they get a hold of you?
Yeah,
if you're a federal employee.
Yes. Anybody technically, but yes, federal employee. ChristyCapital.com. You click talk to an advisor. The message will get to us. The book is at ChristyCapital.com/decisions. Takes you straight to where you can order the book if you're a federal employee.
Okay. Thank you so much. I really appreciate you. So if anybody'd like to reach out to me, they can reach out to me at paulachristine.com.